I'm Jusko from ProudMoney.com. Are credit scores fair? And as sort of a side question, why does your credit score drop sometimes for no reason? That's what we're going to talk about in this video. But first, I'm going to ask you to please subscribe to this YouTube channel if you have not already. And if you have already, I thank you for doing so. So when we talk about credit scores, invariably I get a lot of comments with people talking about the fact that their credit score dropped, in particular when they have paid off a debt, which feels like the exact opposite of what should happen. And then other times people say that their credit score dropped for no reason at all. So in this video, we are going to talk about sort of the fairness of credit scoring. Is it fair the way that credit scores are constructed? And then we'll also talk about that question of why your credit score drops. And then we'll also talk about some stuff sort of in between the lines. So let's start, as we often do when we talk about credit scores, with this pie chart that was created by FICO, which is the biggest of the credit scoring models. And it shows the 5 components of a credit score, and it gives a percentage in terms of their importance of each one of them. These percentages not set in stone. In some cases, FICO is going to sort of use a model where some of them are going to be more important for people newer to credit. Some of them are going to be more important for people that have a more established credit history, but these are sort of the rough percentages that go into a FICO score. So let's look at each one and talk about whether it is fair or not. The biggest chunk at 35%, payment history. Do you pay your bills on time? It makes sense that this would be the most important thing when it comes to lenders trusting you in the future with credit cards or other types of loans. So is that fair? It feels fair to me. It seems like it should be the most important piece. And remember that when we're talking about payment history, it is, do you pay your bills on time? But even if you don't pay your bills on time, it doesn't necessarily mean were you 2 or 3 days late. It means were you very late? Were you 30 days late, 60 days late, 90 days late? Did you fail to pay off a loan or credit card altogether? So payment history isn't just like, I sent my bill in and it didn't get there until 1 or 2 days afterwards. When you get penalized in your credit score, it is for paying significantly late. And as far as I'm concerned, that feels fair, and it should be a big piece of your credit score as it is. The second most important piece to your credit score, according to FICO at 30%, is what they call amounts owed. And amounts owed is a little misleading when you know what that contains within it. Now, on one side, we have installment loans. We've got mortgage loans, we've got auto loans, personal loans, that sort of thing. And when we hear the term amounts owed, well, the more we owe, the worse it sort of is, or at least the more we owe compared to what the original amount of the loan was. So you get a new auto loan, that's going to hurt you a little bit because suddenly you've got this big pile of debt, but then as you pay it off, as that number gets smaller, you are going to get rewarded in your credit score. That is pretty easy to understand. What is harder is on the credit card side. It's on the credit side that amounts owed becomes sort of misleading, because what they actually use in the credit scoring models is what is known as credit utilization, which is not a concrete number. It is instead a percentage. And that percentage is how much debt, what is the balance you have on your credit cards compared to the overall available credit that you have. So someone that has not a lot of available credit could end up being penalized for having the exact same amount of debt as someone that has a lot of available credit. So if I'm sitting here and I have, $1,000 of available credit and I spend $500 on that credit card that I have, I am at 50% credit utilization. I'm using half of everything that I potentially could be using. However, somebody else might have $10,000 in available credit, and if they used one of their credit cards, put $500 of purchases on it, that's only 5% of all the credit that is available to them. So I'm getting penalized for having 50% credit utilization, even though I am spending the same $500, putting that same $500 on my credit card as the person that has $10,000 of available credit, and they are getting rewarded because that is only 5% of the credit that is available to them. Is that fair? Well, it might be fair on the high end because the person that has $10,000 worth of available credit, you could make the case that they obviously have done some things right with their credit history to get themselves $10,000 of available credit to begin with. So if they spend $500 on their credit cards and they're only using 5%, well then maybe they should be rewarded. They've already done some good things to even get themselves to that place where they could get $10,000 worth of available credit. So I could make that case maybe. However, on the other end, if someone has $1,000 worth of available credit, penalizing them for using half of that available credit does not seem fair. They haven't done anything wrong. They've gotten the credit that they were able to get. They've used it if they are paying their bills on time and there hasn't been an issue. Why are they getting penalized for using the exact same amount of credit as the person that has more available credit? And not only that, using credit utilization within a credit scoring model creates sort of perverse incentives. On the side of people that have more available credit already, they are sort of incentivized to keep their credit cards open because they know if they close a credit card, even if they don't use it anymore, it could hurt them because their credit utilization would go up because their available credit would go down. On the other side, someone that has less available credit, they are sort of incentivized to get more available credit, even if they don't need it, in order to get that credit utilization number to go down and raise their credit score. So we're sort of incentivizing people to do behaviors that aren't necessarily good for them and aren't necessarily even good for the lenders who are giving them this money. In truth, amounts owed really should be what is your debt in comparison to your income or your assets. But FICO and the credit reporting agencies, TransUnion, Equifax, Experian, they can't really go to every person and ask them what their income is. And so you have a credit scoring model that is sort of trying to decipher what someone's income might be based on the available credit that they have been given in the past. So it's a very imperfect way to try to figure out what the debt is in relation to their income, and so you get a lot of people being scored wrong because of it. Next chunk at 15% is length of credit history, and to me this feels very fair. If you are new to credit, you shouldn't be rewarded in the same way as someone who has established that they can use credit over a longer period of time. So no fun in those first 2 or 3 years to be doing the right things and not getting as much credit as you deserve in your credit score, but it makes sense. It's pretty much like everything else in life. When you are new, you are not trusted to the same level as someone who has done the right things over a long period of time. If you got a new job, you wouldn't think, oh, I didn't screw up today, they should make me CEO tomorrow. Same thing with your credit. You make one credit card payment on time, you shouldn't be rewarded in the same way as someone who has made a year's worth or 5 years worth. So I think that makes pretty much sense, and that's pretty much how the credit scoring model works. That reminds me, I watched the first few episodes of the second season of Ted Lasso yesterday, and spoiler alert here, Jamie Tart comes back to the soccer team, football team, whatever you want to call it, and if you've watched Ted Lasso, you know he was kind of the bad guy of the first season, really good player, but really bad guy to everybody else on the team. So when he comes back, they don't really want him back. The other players are upset, they don't want to be his teammate, and they treat him badly, and he is trying to sort of change himself and get back in their good graces so that they will trust him, and so he does some things in the episode to start going in that direction. Sometimes when I talk about credit scores, I call them trust scores. So someone like Jamie Tart has hurt his trust. He's like someone that has bad credit because of missed payments, maybe a bankruptcy, has to work his way back into the good graces of the banks or his teammates in this analogy, where somebody else who is a rookie doesn't have anything against them, but they haven't done anything to really earn that higher credit score yet. So they got to do things over time to show that they deserve more points and they deserve the trust of their teammates or the banks in this extended Ted Lasso analogy. Now, I think those things are all good and right when we talk about length of credit history. However, there are things in the credit scoring models where sometimes you get punished for doing the right thing, and we're going to talk about that next. Next piece at 10% is credit mix. Credit mix means the mix of credit types that you might have. If you have more than one type of credit, that helps you in your credit score. So if you're someone that has successfully dealt with installment loans and revolving loans like credit cards, well, then that gives you a few more points than someone that has only had installment loans or only had credit cards. Is that fair? I think it's sort of fair in the fact that those are a little bit like two different disciplines. An installment loan requires you to pay the same amount over a longer period of time every single month, where a revolving credit card gives you a lot more leeway. You still have to pay every month, but you have to make a lot more of the decisions and try and keep your debt under control. So I do understand that. However, one of the things that drives people crazy is that when they get installment loans in particular, oftentimes when they pay off that installment loan in full, all of a sudden their credit score drops. Not fair! I'm sorry, I got that Ted Lasso in the brain. That wasn't even a very good British accent. Anyway, why would FICO do this? Why would they penalize you for paying off an installment loan? Well, the reason is, and I've seen them talk about this in a few different places, they don't really care what logic says. Logic says when you pay off a loan, you should be a better risk because you have just proven that you can pay off an installment loan. But what they would say, what they have said, is that the numbers show that once someone has paid off an installment loan, they actually are riskier than they were when they were still paying on that installment loan. So while that auto loan was active, while that mortgage was active, they were actually less risky as a borrower going forward than once they had that paid off. Now, I don't know what the psychology is there, and I don't think FICO cares what the psychology is. They only care what the numbers are because you are not really their end customer. The lenders are their end customer. So if the numbers tell them that when someone has paid off an installment loan, they have become riskier, well, then that's going to become part of the credit scoring model. Fair? Maybe not. But again, the lenders are their end customer. The final 10% of your credit score is new credit, which means new accounts opened in the last year as well as new attempts to get credit in the last year, what we often call hard inquiries or hard pulls, when a lender looks at your credit report to assess you for a new loan or for a new credit card. It makes sense you would get dinged on new accounts. If you open a new account, you become riskier, at least in the short term, until you've proven that you can handle that on top of whatever other credit you already have. The inquiries, it's a little harder to decide how fair those are. Maybe if you got dinged for every, 3 to 5 inquiries per year, that would make more sense than getting dinged for every single one, especially if you're getting dinged for an inquiry on an account that you actually got approved for. You're already getting dinged on the new account end. You shouldn't necessarily get dinged on the inquiry end as well. But anyway, I'm sure FICO would say, this is how it works. We look at the numbers. When someone has more inquiries, no matter if it's 1 or 2 or 3, their risk goes up, and so we plug it into the formula to help our lender customers. So overall, I think the credit scoring models are mostly fair, but there are some glaring weaknesses. There are some glaring holes where the interests in maximizing the profits of lenders are creating unfairnesses for consumers, actually penalizing them for good behaviors or for behaviors that are at least attempting to be good. And so I don't necessarily want the government getting involved here. We talked earlier in the year about some rumblings of the government creating their own credit scoring models. That doesn't necessarily seem like the answer either. But hopefully for you, if you're wondering, not understanding why your credit score goes down sometimes, even when you do the right things, hopefully that has helped you out a little bit. I would love to hear your questions, comments, whatever, in that comment section below. Otherwise, I thank you for watching. And as always, please go to proudmoney.com, where we do credit card reviews and we talk personal finance and we talk deals and all sorts of other fun stuff too. Thanks for watching. Bye.